Imagine you're sifting through a pile of information, maybe trying to figure out how a company spots potential problems early on, and you need to extract the crucial pieces without getting lost in the details.
Right.
That's precisely what we're tackling today.
Getting straight to the vital insights,
Mhm.
that's definitely the goal.
Today, we're taking a deep dive into what auditors consider when looking at a company's internal audit function, and importantly, how they use information technology, all within the context of, auditing the financial statements.
hmm
We're drawing from a document called ISA 315 for
Yeah,
this.
ISA 315, it's pretty much a cornerstone for how auditors approach their work, especially risk assessment.
You shared this material because, well, you want to understand how auditors assess the risks tied to both the traditional internal checks within a company and increasingly the role of its technology.
That's right.
So, our mission here is to pull out the most significant aspects, giving you, the listener, a clear and efficient grasp of what's really important.
Exactly. Getting these foundational elements down unlocks a sort of deeper appreciation for the auditor's mindset.
Okay, so this deep dive is based on excerpts from a professional auditing standard. Now, that might sound a bit dry,
A little
perhaps,
dense sometimes, yeah.
but we're going to break down the key takeaways for you in a way that hopefully makes sense. Okay, let's unpack this, starting with the internal audit function itself. The standard really emphasizes how crucial it is for an external auditor to understand what the internal audit team is all about, their objectives, and, well, what they actually do.
Absolutely. You can think of the internal audit function as like an internal set of eyes and ears for a company's management and those charged with governance.
So the board, the audit committee, that kind of level.
Exactly. The people ultimately responsible for oversight. The internal audit gives them insights into how well the company's managing risks, its internal controls, its governance processes.
Mhm.
So for an external auditor, just knowing what the internal auditors are focused on, how they conduct their work, that provides a really valuable initial perspective.
Right. And I suppose if the internal audit function is well-resourced.
That's a key point. A well-resourced function often signals a greater commitment from management to strong internal controls.
Which can give the external auditor more confidence? Maybe change their approach?
Potentially, yes. It could allow for a more focused audit approach in certain areas.
And it's not just what they audit, is it? The standard mentions resources, how they're structured, who they report to.
It does. All of that paints a picture. The independence and competence of the internal audit function are really significant factors for the external auditor.
Independence, meaning they aren't swayed by management.
Ideally, yes. If they have a broad scope, enough resources, and report to someone high up and independent, like the audit committee, their work generally carries more weight.
And that can influence the external auditor's plan, like what tests they do and when.
It can. It affects the nature, timing, and extent of their own audit procedures.
Okay, here's where it gets interesting for me. Standard says internal audit responsibilities might include evaluating risk management and internal control. That sounds like it could feed directly into the financial statement audit.
Precisely. That's a critical link. If internal audit is actively looking at and testing the controls relevant to financial reporting,
The ones that ensure the numbers are right.
yes, those ones. Their findings, what worked, what didn't, give the external auditor really important information about the reliability of those controls. It's almost like getting a head start on understanding the control environment.
But what if their main focus isn't financial reporting? Say they're looking at, I don't know, operational efficiency, making things run smoother. Is that still relevant?
Indirectly, yes, it can be. When internal audit finds problems in operational areas, it might point to underlying weaknesses in the company's broader control environment.
How so?
Well, say they find significant inefficiencies in the purchasing process. That might suggest a lack of proper authorization controls, for example.
Ah, and that could potentially lead to errors in the financial statements, like incorrect inventory costs or expenses.
Exactly. So even operational findings can sometimes be a red flag for the financial audit.
That makes sense. Now, the standard also talks about the external auditor actually talking to the internal audit team, making inquiries. What are they trying to get from these conversations?
Well, the main goal is for the external auditor to get a really good understanding of what the internal audit function does, their activities, their plans.
What's on their radar?
Yeah. And also their understanding of the financial reporting framework. Do they know the accounting rules? And importantly, their knowledge of the company's own system of internal control. It's like getting another expert view in the same territory.
A view from the inside, almost, since they're
If it-
there all the time?
That's a good way to put it. They're on the ground within the organization, often doing reviews continuously. They can offer insights into processes and controls that an external auditor, who comes in periodically, might not see as easily. And presumably, if internal audit has already found weaknesses or identified specific risks.
Oh, absolutely. That's incredibly valuable information for the external auditor's own risk assessment.
Their reports, recommendations for fixing things.
Hugely helpful. It helps the external auditor pinpoint areas where there might be a higher risk of errors or misstatements in the financials, lets them focus their own work more effectively.
The standard specifically calls out when internal audit flags suspected or actual fraud. That must set off alarm bells.
It's a critical piece of information, a major red flag, as you say. The external auditor has a responsibility around fraud risk, and anything from internal audit on that front is key input for their assessment. It definitely raises the level of scrutiny. Okay, and it's not just what information they get, but who it's coming from. The standard stresses understanding the competence and objectivity of the internal auditors. Why those two specifically?
Well, competence is about whether they have the necessary skills and expertise to do their job effectively.
Mhm.
If they don't,
Their findings might not be reliable.
exactly. And objectivity is about whether they can do their work without bias or undue influence. If they feel pressure from management not to report certain things, for instance.
Then the external auditor can't really rely on what they say.
They'd have less confidence, certainly. They might need to do more of their own work to verify things. So competence and objectivity are fundamental to how much the external auditor can leverage the internal audit function's work.
So it sounds like open communication is vital. The standard says it's key for the external auditor's overall understanding of the company and its environment.
It really is. A
Yep.
good, open working relationship, clear communication channels. It allows for a free flow of information and insights. Ultimately, that contributes to a more thorough and effective audit overall.
Right. Okay, let's maybe focus on one specific area mentioned, the control environment. How does internal audit help the external auditor get a handle on that?
The control environment is, the overall tone at the top. The culture regarding internal control, management's attitude, their awareness,
How seriously they take controls.
pretty much. And internal audit often plays a key role in monitoring how management responds when control weaknesses are identified.
So they don't just find problems, they check if management is actually fixing them.
A good internal audit function will, yes, they follow up.
And that follow-through gives the external auditor a sense of whether management is genuinely committed to strong controls.
Exactly. Their work in tracking those responses provides assurance, or perhaps raises concerns, about the effectiveness of the entity's overall control environment. Shows if management is proactive or not.
Okay, that makes sense. Now let's shift gears a bit. Let's talk about technology. It's central to pretty much every organization now, isn't it?
Absolutely, increasingly so.
The standard talks about understanding the entity's use of IT. Why is this so critical for a financial statement audit?
Because, think about it. IT underpins almost all significant business processes today, doesn't it?
Transaction processing, reporting?
Everything from how transactions get recorded and processed to how financial reports are ultimately generated, IT is usually fundamental.
So you can't really audit the financials without understanding the IT.
Not properly, no. To assess where things could go wrong, where errors or even fraud might creep in, the auditor has to understand the IT systems the company uses. That includes the automated bits and any manual processes that interact with them.
And the standard makes it clear IT isn't separate from internal control, it's deeply integrated.
Precisely. Many key controls are IT controls now. They're automated, performed by the systems themselves.
Oh.
The reliability of these controls is directly tied to the underlying IT infrastructure and how it's managed.
The standard mentions some benefits of IT and controls, like consistency, timely information. Computers are good at repetition, right?
They are. Applying rules consistently, making data available quickly. IT can also enhance security access controls, audit trails, tracking who did what.
But there's a flip side.
Well, you need to distinguish between automated and manual controls. Automated controls can be very reliable if the underlying programming is sound and the systems work as intended.
But if there's a bug in the code,
Exactly. That error could be repeated systematically across countless transactions without anyone noticing immediately. That's a key risk.
whereas a manual control, while prone to human error, might catch something unusual.
Potentially, yes. Especially unexpected situations the system wasn't programmed for. So it's often about the interplay between automated and manual controls.
Okay, understanding that mix is crucial. Now, the standard gets into how IT impacts the different components of internal control. And there's a table here, which looks really helpful, breaking it down based on IT complexity.
Yes, that table aims to show how things like the extent of automation, reliance on IT for reports, how data gets in and processed, the sheer volume of data, how all that changes depending on the IT environment.
It compares like simple off-the-shelf software versus mid-sized systems versus big, complex ERP systems.
Exactly. Non-complex commercial software, mid-sized setups, and then larger complex systems.
Let's pull out a few examples from that table. It says for companies with extensive and often complex automated procedures, the controls around processing are more important. Why specifically processing?
Because if lots of decisions and calculations are happening automatically within the system, you need strong controls over how that processing works. The logic, the parameters used, how it executes, these become critical to prevent systematic errors hitting loads of transactions.
Makes sense. Another one, if a company has complex automated report logic, understanding that logic is crucial. Seems obvious, but why highlight it?
Because if the financial reports are being generated through intricate algorithms within the IT system, the auditor needs to, really dig in and understand how that logic works. Only then can they be confident the reports are accurate.
A flaw in the logic could mess up the report, even if the input data was fine.
Precisely. Garbage in, garbage out applies, but so does good data in, garbage logic, garbage report out.
Right. And for companies handling large volumes of data in digital form, it stresses needing robust IT infrastructure and controls. What kind of controls are we talking about there?
That covers a lot. Secure storage for all that data, controls to maintain its integrity, stop it getting corrupted, restricting access, ensuring the systems can actually handle the load reliably. Basically making sure the data isn't lost, changed without permission, or just unavailable when needed.
The table also mentions custom-developed or significantly customized software requiring specific IT controls. What's different about custom software?
Well, with off-the-shelf packages, there might be some reliance on the vendor's built-in controls, though you still need to check configuration. But custom software is unique to that company.
So the auditor has to really scrutinize its specific design and controls.
Exactly. They need to understand how it was developed, tested, implemented, and what controls were specifically built into that piece of software. There's no standard blueprint to rely on.
Okay. The standard also brings up things like cloud services, emerging tech like blockchain. How do they complicate things?
They add layers. With cloud, you're relying on a third party's controls for part of your infrastructure. The auditor needs to understand those controls too, maybe through SOC reports or other means.
So you're looking beyond the company's own walls.
You have to. And emerging tech like blockchain has unique features, different security models, data integrity mechanisms that auditors need to get up to speed on and evaluate. It's often a more distributed, sometimes less traditionally understood environment.
Yeah. And it's not just the tech itself, but the people managing it, right? The standard mentions IT personnel skills, access rights complexity, security over databases.
Absolutely fundamental. Competent, ethical IT staff are crucial. Complex access rights need careful management. Segregation of duties is key here, preventing anyone having too much control or unauthorized access. And securing databases and applications protects the actual financial data.
Finally, in this section, it talks about program changes and integration. Why are frequency of changes and system integration important?
Well, every change to an IT program carries a risk of introducing errors or security holes. So strong change management controls authorization, testing, proper implementation are vital.
To make sure changes don't break things?
Essentially, yes. And if systems are highly integrated, sharing data and processes, a problem in one place can ripple through the whole setup.
Like a domino effect.
Exactly. It increases the risk of widespread errors impacting the financial reports.
Okay, wow. So a really thorough understanding of the IT landscape is clearly fundamental. Now, the standard moves on to specifically discuss IT risks and what are called general IT controls. Let's start with the risks. What are some key IT-related risks auditors worry about?
Well, there are several big ones. Unauthorized access to systems or data is a major concern that could lead to fraud, data theft, or manipulation of records.
Right.
Then there's the risk of data loss, maybe from system failures, ransomware, lack of backups. That can be catastrophic.
Okay.
And of course, simple errors in processing. bugs in software, incorrect system settings, maybe even user error when interacting with the system. These can lead to inaccuracies in the financials.
And to counter these risks, companies use general IT controls, or GITCs.
That's the term, yes.
Yeah.
General IT controls are the foundational policies and procedures that apply across the IT environment. They support the overall effective operation of IT.
Like the building's overall security system, maybe?
Protecting
Everything inside.
That's a decent analogy. They create the framework that allows the more specific application controls the controls within individual software programs to function reliably.
Can you give some examples, maybe linking back to that table again? What falls under GITCs?
Sure. A huge one is managing user access privileges.
Mm-hmm.
Who gets in? What can they do? Like your building access card analogy.
Controlling who has the keys.
Exactly. Ensuring people only have the access they need for their job, and it's removed promptly if they leave or change roles. Tied to that is segregation of duties within IT itself, separating developers from operators, for instance.
So the person building the system isn't the only one running it.
Right. Prevents concentration of power or ability to make unauthorized changes easily.
What about those program changes we mentioned?
Controls over program changes and the whole system development lifecycle are critical GITCs. This is like your building renovation process needs approvals, plans, inspections.
Making sure changes are safe and sound.
Precisely. Authorizing, testing, and properly implementing software changes to prevent errors or security issues. Similar controls exist for database changes to protect data integrity.
The standard also mentioned controls over IT application configuration.
Yes, applications often have loads of settings that affect how they work. GITCs ensure these are set up correctly and stay that way, supporting reliable processing, like ensuring factory machines have the right settings.
And network security must be a big one today.
Huge. Firewalls, intrusion detection systems like building alarms, vulnerability scanning, protecting the perimeter from unauthorized access and cyber threats.
Makes sense.
And data backup and recovery procedures are vital GITCs. Your disaster recovery plan for the building, essential for business continuity if something goes wrong.
And finally, it mentioned job scheduling.
Yeah, controls over how automated tasks or batch jobs are scheduled and monitored, making sure they run correctly and errors are caught quickly.
Okay, so it seems the level of IT risk and the necessary controls really depend on the company, don't they? The standard talks about scalability.
Exactly. It's not one size fits all. A small business with basic, standalone software has a very different IT risk profile and simpler control needs compared to a multinational with complex, integrated ERP systems.
The standard contrasted standalone versus interfaced applications. What's the key risk difference there?
Standalone apps are like separate tools. A problem in one usually stays in one. Interfaced apps share data, rely on each other.
So a problem can spread, like that domino effect again.
Yes, an issue in one system can cascade through connected systems, potentially amplifying risks across the organization. It's like one faulty machine bringing down part of the production line.
And if a company really leans heavily on IT for its core business, for significant transactions, financial data, those IT systems become much more critical for the audit.
Absolutely. They're more likely to harbor risks of significance, as the standard puts it, risks that could cause a material misstatement in the financials. In those cases, management, and therefore the auditor, places a lot more reliance on the application controls within those systems working effectively.
Okay. The standard then lists even more specific IT-related risks. Things like inaccurate data processing, unauthorized access, again, lack of data integrity.
Yes, it drills down further. Inaccurate processing leads to wrong numbers. Unauthorized access can mean fraud or data manipulation. Lack of integrity means the data itself might be corrupt, incomplete, unreliable.
Unauthorized changes to master data, like customer or supplier details.
Very risky. That can impact billing, payments, everything. And unauthorized changes to the IT programs themselves could secretly alter how transactions are processed.
Sneaky. And it mentions failure to make necessary changes too.
Right. If systems aren't updated for new business needs, regulations, or security threats, that's also a risk. Outdated systems can be vulnerable or produce inaccurate information.
Plus data loss and inappropriate manual intervention.
Yep, data loss from bad backups is always a worry. And manual intervention and automated processes can bypass controls, introducing errors or fraud opportunities.
Going back to the general IT controls for a sec, the standard groups them. Data center network operations, system software controls, access security, and application acquisition development maintenance.
Can we quickly touch on what's in each? Data center and network ops.
That's physical security for servers, environmental controls like cooling, power backups, plus network monitoring, firewalls, keeping the core infrastructure running and secure.
System software controls.
Sounds technical.
It's about managing the underlying operating systems and core platform software,
Okay.
patching vulnerabilities, managing upgrades properly,
Mhm.
keeping the foundation solid.
Access security, we covered that a bit.
Yeah, authentication, proving who you are, and authorization what you're allowed to do. Plus user account management, revoking access, segregation of duties, really crucial.
And application acquisition, development, maintenance?
Covers the whole life cycle of business software, selecting purchase software carefully, controlling in-house development with testing and documentation, managing ongoing changes and updates effectively, and, importantly, data conversion controls when switching systems, making sure data moves accurately.
That detailed table really seems to tie it all together then, showing the links between IT processes, risks, controls, and complexity.
It does provide a good framework. You see how user access controls, for example, become much more formal and critical as systems get larger and more complex.
And application changes need more rigorous processes, documented approvals in complex environments because the impact is bigger.
Exactly. Same for database changes, from maybe no user changes allowed in simple systems to formal authorization and testing in sophisticated ones. The rigor scales with the risk.
Data conversion needs management oversight. Network security gets more advanced with segmentation and vulnerability scanning.
Right. Even backups move from manual to automated comprehensive solutions. And job scheduling needs tighter restrictions and monitoring in complex, automated environments.
So wrapping this up, from our deep dive into ISA 315, you can really see this dual focus for auditors, can't you? Looking at traditional internal checks and the absolutely crucial role of IT. Understanding the internal audit function, their objectives, scope, the inquiries made, and then deeply understanding how IT is woven into the fabric of internal controls. It all builds that comprehensive risk picture.
It really highlights how interconnected things are and how central technology is now to having a strong control environment. You can't really separate them anymore.
Definitely. And thinking ahead, considering how fast technology keeps changing, how do you see this relationship between internal audit and IT risk assessment evolving? It feels like a constantly moving target.
Oh, it absolutely is. It's a dynamic landscape. I think going forward, we'll see an even greater need for specialized IT audit skills, both within internal and external audit teams.
Deeper tech knowledge required.
Definitely. Understanding and assessing risks related to things like AI, advanced data analytics, increasingly complex cloud setups. That's going to be critical. The ability to audit through the technology, not just around it, will only become more important.
A fascinating area to watch. Well, we really hope this deep dive has given everyone listening a clearer, more insightful understanding of these important concepts from ISA 315.
Hope it's been useful.
And if you, the listener, have more questions, or perhaps other source materials you'd like us to explore in future deep dives, please don't hesitate to share them with us. We're always ready for the next deep dive with you.